let's take a look at the journal entries involved with inventory, purchases, and returns. So in this case, we're going to be the ones making the purchase, and let's go ahead and take a look and see what those entries might appear to look like. So it says, By the River Spas Inc. purchased $10,900 worth of inventory from the pool doctor on account, terms 110 net 30. Some of the goods are damaged in shipment, so By the River Spas Inc. returns $2,200 of the merchandise to the pool doctor. So it's asking us to first journalize the purchase of the goods. So we will go ahead and do that. Okay, so we're going to buy merchandise. We know that means we're going to have to debit inventory for the cost of that merchandise. In that case, it's $10,900. That has the effect of increasing my inventory. It's an arrow. And instead of paying cash for that, we're buying it on account. We're going to have to pay for it in the future. So we will credit accounts payable to the pool doctor. That will go directly to their account with us, $10,900. And that will also increase that liability now by $10,900. So then B says we return some damaged merchandise. So you all know when you go to the store and you return merchandise, what happens? Well, they either credit your account with them, or they give you cash back. So in this case, we're going to go ahead and debit our accounts payable. You'll see where the credit part comes in when we look at from the seller's perspective here in just a few minutes. So accounts payable pool doctor for $2,200, and we credit inventory. This is the exact opposite of what we did in A. We're reversing that journal entry for $2,200. So we are just doing the exact opposite. We'll credit our inventory, which decreases our inventory, and we're debiting our accounts payable, which is actually decreasing that. Now here comes the tricky part. Part C, we're going to go ahead and pay for our merchandise within the discount period. Well, there's a couple of things going on here. One, how much did we actually buy from By the River Spas? Well, we ordered $10,900 and we returned $2,200. So that means we only really have $8,700 worth of merchandise. And the other way we could look at that is to draw our little T account from our accounts payable. Sometimes this is very helpful, especially when we have multiple customer accounts going on. And we'll see we had a credit for $10,900, and then with the return $2,200. So their balance in our books that we owe them is $8,700. Okay, so we're going to debit accounts payable for $8,700. It's going to go ahead and remove that liability altogether. We won't owe pool doctor any more money. We need to credit cash, but here's the deal. We get a discount. It said 1% discount if we pay within 10 days, or we pay the full amount within 30 days. So it says in the problem that we get to pay it within the discount period. So we'll get to take a 1% discount. So actually we would credit inventory for the amount of the discount. The reason is because our inventory isn't actually costing us $8,700. It's costing us $8,700 less 1%, which is $87. And then the cash that we'll actually pay them will be the difference between the two, which is $86.13. So we're not going to pay pool doctor $8,700. We're going to pay them $8,700 less the discount of $87. Thank you.